Hey there, investors! Today I'm diving into how the recent French election brought a wave of relief to Europe's stock markets. Let's break it down. First off, why was this election such a big deal? France is one of the EU's largest economies, so what happens there has a huge impact on the entire region. Leading up to the election, there were worries about populist and anti-EU sentiments gaining traction. The fear? A candidate might win who wanted to pull France away from the EU or adopt protectionist policies, creating a lot of uncertainty. But the election wrapped up with a win for a pro-EU, market-friendly candidate. Investors loved this outcome. It signaled that France would stick with its cooperative stance within the EU and support economic reforms, which is great news for market stability and growth. Now let's talk numbers. As soon as the election results were announced, there was an immediate and noticeable impact on Europe's stock markets. The Stoxx Europe 600 index surged, reflecting broad-based gains across various sectors. France's CAC 40 index also saw a notable rise, driven by a surge in shares of French companies. Even the UK's FTSE 100 and Germany's DAX posted gains, showing a positive spillover effect across the region. But wait, not all sectors benefited equally. The financial sector, including banks and insurance companies, saw substantial gains due to anticipated stability in regulations and continued economic reforms. Companies in the consumer goods and services sector also got a boost, with expectations of higher consumer confidence and spending. And the industrial sector, covering manufacturing and construction, benefited from the prospect of pro-business policies and infrastructure investments. So what are the broader implications for the European economy? For starters, the election outcome is seen as a stabilizing factor, alleviating fears of political instability. This reduction in uncertainty is likely to strengthen investor confidence, potentially leading to increased investment flows into the region. Plus, the pro-EU stance of the new French administration reinforces EU cohesion, which is crucial as the region faces challenges like Brexit, trade tensions, and economic recovery post-COVID-19. Looking ahead, several factors will shape the future outlook. The effectiveness of the new administration's policies will be crucial. Investors will be watching closely for progress in economic reforms, regulatory stability, and pro-growth initiatives. Geopolitical developments, trade negotiations, and regional conflicts will also play a role in market dynamics. And of course, macroeconomic indicators like GDP growth, inflation rates, and employment figures will continue to shape investor sentiment and market performance. In conclusion, the recent French election brought a wave of relief to Europe's stock markets, highlighting the importance of political stability and pro-market policies for investor confidence. The positive reaction across major European indices underscores how interconnected political events and financial markets are. As the new French administration embarks on its agenda, maintaining the momentum of stability and growth will be pivotal for the broader European economy. Remember, political clarity is key to fostering a conducive environment for economic prosperity and investment. That's it for today. Thanks for tuning in, and happy investing.